The U.S. banking system is on the brink of collapse, with official data indicating that half of all banks are at risk of insolvency. This situation poses a threat to the safety of your money, and it's crucial to consider alternatives for preserving wealth. The crisis began with the collapse of Silvergate Bank on March 8, 2023, followed by the significantly larger Silicon Valley Bank, SVB, on March 9, which had over $120 billion in uninsured deposits. The initial response saw uninsured depositors at risk, but by March 11, the FDIC reversed its decision and insured all deposits. Further turmoil included the shutdown of Signature Bank and the forced merger of UBS and Credit Suisse. Despite a $1 trillion bailout and 5 bank failures in 2 months, experts like James Rickards warn that the crisis is far from over. Historical patterns show that financial crises develop in stages, with a quiet period before the critical phase. The current crisis could escalate quickly due to modern technology enabling rapid bank runs. With major institutions and individual banks still vulnerable, the situation could worsen dramatically, highlighting the need for ongoing vigilance and preparedness. The regulatory response to the current banking crisis reflects past experience, prompting questions about whether regulators are now depleted of effective strategies after exhausting most guarantees. Distinguishing between individual bank failures and systemic crises is critical. While depositors and creditors are typically protected in isolated failures, stockholders face potential losses. In contrast, systemic crises necessitate broad interventions such as blanket deposit guarantees and extensive quantitative easing, akin to historic measures like bank closures during the Great Depression. The current phase suggests we've moved beyond a quiet period into the second stage of a deepening banking meltdown. Recent data underscores the heightened vulnerability of the U.S. banking system due to Federal Reserve interest rate hikes. This has exacerbated risks, particularly if uninsured depositors trigger bank runs during crises, leading to potential insolvencies. The FDIC's alarming quarterly report highlights numerous banks nearing failure, with unrealized losses on securities soaring to $177 billion in just 3 months. Over 2,300 banks, including major institutions, face asset-liability mismatches, indicating widespread financial fragility. Concurrently, commercial real estate and mortgage-backed securities are experiencing significant declines, echoing echoes of the 2008 crisis. A pervasive uncertainty looms as thousands of banks face undisclosed vulnerabilities, potentially impacting depositors across America. With limited FDIC resources to cover deposits, concerns about banking stability intensify, compounded by past bail-in plans and systemic risks stemming from policy shifts by the Federal Reserve and Treasury. Analysts warn that unless there's a significant policy reversal, the crisis could escalate further, jeopardizing financial institutions, the economy, and personal finances amid the unfolding second stage of this crisis. If you enjoyed this video, consider subscribing for more content like this. Your support helps us create valuable videos. Join our community and stay updated by subscribing today.